You just got $50,000, an inheritance, a bonus, a home sale. Someone tells you to invest it all today. Someone else tells you to spread it out month by month to avoid buying at the top. They call this dollar cost averaging, and they say it's safer. Here's what the research actually shows. Lump sum investing beats dollar cost averaging about 2/3 of the time. Not because timing the market is smart, because time in the market is the whole game. The longer your money sits in cash waiting to be deployed, the more expected return you sacrifice. Vanguard's 2012 research paper, still the most cited study on this topic, analyzed US, UK, and Australian markets across 10-year rolling periods. In the US, lump sum investing outperformed dollar cost averaging over 12 months in 68% of periods, by an average margin of 2.3% in the first year. The reason is straightforward. Markets go up over time. If you assume the market will be higher in 12 months than today, which history strongly supports, putting your money in today is almost always better than parceling it out. So why does everyone recommend DCA? 2 reasons. First, it's psychologically easier. If you invest $50,000 today and the market drops 20% next week, you feel terrible, even if you intellectually know you should hold. Most people don't hold. They panic sell at the bottom. DCA reduces regret by reducing how much you could have timed wrong. Second, DCA with regular payroll contributions is genuinely the right strategy when you're investing out of your paycheck, because you don't have a lump sum to begin with. That's a different situation entirely. The math on a $50,000 lump sum versus $4,167 per month for 12 months. Assume average S&P 500 return of 10% per year. Lump sum, by year end, the full $50,000 has had a full year of compounding, expected value, $55,000. DCA, on average, each tranche has been invested for 6 months, only half a year of expected compounding, expected value, $52,500. The lump sum wins by $2,500 in expectation. Now, in the 32% of periods where the market falls in year 1, DCA wins, sometimes significantly. The question is whether you can tolerate the 32% downside scenarios. The behavioral finance problem. Studies show that most individual investors who invest a lump sum and see it drop 20% in the first year sell at a loss. They don't hold through recovery. The mathematically superior strategy only stays superior if you can actually execute it without panic selling. If you know, honestly, that you would sell during a significant downturn, then DCA isn't just the psychologically easier choice, it's the better practical choice for your specific behavior. A strategy you'll stick with beats an optimal strategy you'll abandon. A middle path that many financial planners recommend: invest a substantial portion as a lump sum, 50 to 70%, and DCA the remainder, over 3 to 6 months rather than 12. This captures most of the lump sum advantage while reducing the psychological risk of a full, all-in investment. If the market drops immediately after your lump sum, the remaining tranches buy at lower prices and partially offset the loss. If the market rises, you still have the majority of your capital compounding from day one, where DCA genuinely wins when investing from income. If you're putting $1,500 per month from your paycheck into a Roth IRA or 401k, you are by definition dollar cost averaging, buying more shares when prices are low, fewer when high. This is exactly the right approach for ongoing contributions. The DCA versus lump sum debate only applies to a specific situation. You have a large sum of cash right now and need to decide how to deploy it. For most people building wealth through regular savings, this debate is academic. The tax implications matter for taxable accounts. If you're investing in a taxable brokerage, DCA over 12 months means 12 separate cost basis purchases at potentially 12 different prices. This can actually simplify tax loss harvesting opportunities. If one tranche is down, you can selectively sell it to realize a loss for tax purposes while maintaining your overall position. In tax-advantaged accounts, this doesn't matter, but in a taxable account, it's worth considering. The honest conclusion from the research: if you have a lump sum and a long time horizon, invest it today. The expected value math is on your side. But expected value is a statistical concept. It assumes you'll hold through volatility. If you genuinely won't, DCA over 3 to 6 months is the right practical choice. Know yourself. The worst outcome isn't picking DCA over lump sum. It's investing a lump sum, watching it drop 15%, and selling before the recovery. The research says lump sum wins 2/3 of the time, but the research assumes you hold. Only you know whether you will. Make the decision that keeps you invested for the long term, because the worst financial outcome is leaving the market entirely. If you want to understand what you're actually buying when you invest in the S&P 500, our video on what you're actually buying when you buy VO breaks down exactly what that index represents and why it's the default choice for most investors.